Okay, so we'll go ahead and call the firefighter pension board meeting to order. First item on the agenda is the Pledge of Allegiance.
Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Next item is an open forum. Do we have anybody wishing to address the board? None. First agenda item is approving the minutes dated for the March 10, 2022 meeting.
Move to approve the minutes.
A second.
Any discussion? All in favor? Aye. Any opposed? Okay. Thank you. Second item is the election results for 2022.
I don't think we need a recount or anything.
No, Kenny was unopposed, so he was appointed for the next 2 years.
Sorry, Kenny. Thank you, Kenny.
It's all good.
Next item is update on the city-appointed trustee vacancy.
Okay, as you know, John Hill, at the end of his term, he retired. He is moving up to North Florida, so we had to find a new city appointee.
Okay.
Sandy Grimes has accepted the position,
Okay.
and she's not able to join us today. She was approved by council last night, however, so she will be here at the next meeting.
Okay. Thank you. Next item is the quarterly pension plan investment report dated 3/31.
Jeremy Langley from the League of Cities is not able to be here today, so I'll just kind of go through the activity from the plan for last quarter. Actually, it's the quarter ended March 31st. The plan started out the quarter in January with a value of $9,689,720. Then in the quarter at a value of $9,246,091. It was a rough quarter, as everybody else has experienced. It had a loss of $464,000 for the quarter, which took back some strong gains that we experienced in the first quarter of the fiscal year. The returns were negative for the year, for the quarter, for 4.79% down. Fixed income took a hit, and real estate was up about 7%. The April statement, we realized another loss of about $452,000, and the May statement was up about $30,000, which of course doesn't offset anything. So overall, through May, we're down about $480,000. Most of that's because the first quarter was very strong. We don't have the June statement yet, so that should be coming out pretty soon. Then I'll send that out to the board when it's ready. Okay. Going through the quarterly activity, we have pension contributions from the city and employees totaling $53,000. We have benefits distributions totaling $21,216.72. There's one retiree, one disability retirement, and then one beneficiary payment that was paid out. We also had payments for some of the administrative expenses. We have payments to the attorney for retainer and travel costs November 21 through March of 22. And we also had a payment to the quarterly plan manager, or quarterly plan management fees totaling $4,383.65. So, okay. Any other questions on the investment statement?
I wish they would come out more timely, but
Pardon me?
wish they would come out more timely.
Yeah, he was able to attend the June 1st meeting, but, the statements, right.
Yeah.
Yeah, the monthly statement should be coming out soon. We don't expect the quarterly investment statement until middle of August.
Okay. No discussion. The next item is the quarterly admin budget versus actual.
The quarterly administrative budget report through March 31st, you'll see that the legal fees, let's see, get to that one here again. Okay, we do see legal fees coming through as of March 31st, and mostly those are payments, for the retainer through, November through, it was through March, and through February. It was through March 22, and there were some travel costs involved. And also the plan administrator fees are reflected in there. Those are right on target. We had a travel expense reimbursement of $167, but otherwise the administrative budget looks on track. For the next budget, we will see, actually the year-end budget, because we're already past June 30th, we will see the payments that are going to be requested for approval in this statement. So they'll have the audit fees and the actuary and different things coming through. Okay, any questions?
Any discussion on the? So the next item is the audited pension fund financial statement.
Okay, for fiscal year 2021, the board elected to have a separate audited financial report, and they engaged Wells, Hauser, Schatzel to prepare the financial statements and complete the audit. John Hauser, CPA, is here to present the audited financial reports. John, welcome, and thank you for attending.
Yes, good to be here. We've completed our audit for the fiscal year ended 9/30/21, and here we are after mid-July. So this is kind of ancient history. We've also issued our report called the Required Communication, which is a 2-page report, I believe is up on the screen here. And the highlights of that are that there were no new accounting policies adopted during the year, and there are no change to the existing policies. The most significant disclosure is Note D in the financial statements, which we'll go through, is the disclosure of the plan's funded status. We had no difficulties in dealing with management during the performance of the audit. There were no proposed journal entries, and we had no disagreements with management as far as accounting policies or presentation. As Ms. Nino said, September 30, 21, you elected to have a separate report. That's kind of going on a rotational basis. Later in the meeting, you'll see we've presented 2 engagement letters for 9/30/22 on the same basis, separate report or combined with the city. This separate report includes our independent auditor's report on page 1. At the bottom, our opinion is that it's an unmodified opinion. The financial statements fairly present the net position and changes in net position for the fiscal year ended 9/30/21. The very back, there's a report on internal control and compliance. We noted no material weaknesses or significant deficiencies in internal control, and no instances of non-compliance with laws and regulations. The first statement is the statement of net position on page 3. You're almost there. There we go. Overall, the total assets increased about $1.6 million. That's primarily from investment gains during the year, as well as contributions. Liabilities, which are the advanced employer contribution and the due to share plan, increased about $40,000. And overall net position increased $1,555,480, up to a total of $8.4. We saw earlier on your investment statement for March, you were about 9.1. So, it's gone up since then. There were some declines, I think Cindy said, in May, but hopefully that'll be turning around. Page 4 is the statement of changes in net position. The additions, which include your contributions, the fire insurance premium tax and investment return, we're up about $950 from the prior year. Once again, primarily due to the increase in investment returns of $1.4 million for the year compared to $400,000 in the previous year. The deductions are for benefit payments and administrative charges. The total deductions were up about $59,000. You can see in benefit payments, $115 that includes a share plan payout to one of the retirees of about 51,500 during the year. So that's the reason for the increase in the benefit payments. It's a one-time payout. Overall net increase in net assets of net position of 1,555,000. Started at 6.9, wound up at 8.4. The notes to the financial statement disclose the description of the plan on page 5. Summary of significant accounting policies starting on page 6. And then on page 8 is the note D, the plan's funded status. Out the middle of the page, one page back, maybe. There you go. Under the net pension liability asset, the liability actuarially determined was about 7.5. Plan's fiduciary net position was 8.5. So you had a net pension asset of over $1 million. And that's, once again, primarily from those investment returns. So the plan was funded 113% over the actuarial determined liability. Page 9, the way that liability is determined, you'll see, I guess you're going to have your actuarial evaluation presented later in the meeting, is it's based on a discount rate. And I guess you're going to also discuss that later in the meeting. The discount rate for 9/30, 10/1/20 valuation is 7%. Now, that showed the pension asset of $1 million plus. If the discount rate decreased 1%, went down to 6%, it would actually have a liability of $278,000. So that discount rate does affect how, what your contribution rate is, as well as the funded percentage of the plan. If the discount rate went up to 8%, you'd be funded at a higher level. You'd have an excess funding of $2 million based on these 9/30/21 numbers. And page 12, note G, is a detail on the administrative expenses. Overall, they're pretty much the same. Legal fees, insurance, investment fees, the audit fee, admin, actuarial fees, conference fees, expense reimbursements, and membership dues. Really, the legal fees and your investment fees are the larger expense categories within administration, is followed by the audit and the actuarial fees. Page 14 is what's called required supplementary information. This shows the net pension liability asset as well as a schedule of contributions for the last 10 years. And that first table, the net pension liability asset, from 10/1/12 to 9/30/21, every year you've had excess funding. You've been more than 100%. It's only in 2012 and 2019 that a liability was actually shown. So overall, the funding percentage of the plan has been very, very high, or close to 100%, as well as the schedule of contributions and percentage of the covered payroll. And it kind of gives you an idea what contribution rates were. Page 15 and 16, facing pages, so you're only going to see one on the screen probably. But this shows the actually 8 years of historical information, because this Governmental Accounting Standards Board Statement 67 went into effect for 9/30/14. When 10 years of information is available, we'll add a year every year. Eventually, it will reach that 10-year. But it does show the plan funded percentage. Once again, only in 2019 was it less than 100%. And at the very bottom of the page is the average money weighted rate of return. And, that you kind of compare that to what your discount rate is. I mean, that discount rate is what you think you're going to earn, and what you think you're going to earn. So 9/30/21, it was pretty high, 19.3%, compared to a discount rate of 7. In previous years, it was around 5, 6, 7% in 2019 and 18, 13% in 17, 8% in 16. 15 was just a horrible, horrible year. Less than 1%. And 14 about 8.5. So overall, pretty solid average money weighted rates of return. I'd like to thank management, Cindy and her staff for their assistance in completing the audit. And if anyone's got any questions, I'll try to address them now.
Any questions on the audit?
I've got two odd ones that I don't know if they pertain to you or Cindy. One is the COLA, the cost of living, automatically 3% in the plan?
That's the actuarial determination as far as that goes. And I guess it's collective bargaining agreement.
Is that as part of the plan design?
Yeah.
Right.
Yeah, this is Chuck, the actuary. Yeah, the plan has an automatic 3% cost of living adjustment that is built into the plan. And it's not something that, it's not a decision that has to be made each year. It is a part of the current plan.
I was trying to find it. And then the other one is, and again, this is more general, that as I was flipping and he was talking. So we have 5 terminated or not terminated, separated, whatever you want to consider them, employees. Are they able to withdraw their funds or does it have to stay in the pension?
We have now, my information is as of October 1 of 21, we had 4 individuals who had terminated their employment. They were not vested and they are due a refund of their contributions. I don't know the administrative process for getting that done. I'm not sure, if they have to proactively request the refund or if the plan administrator, as soon as they're notified they terminated employment, do they reach out to them? But it looks like as of October 1, 21, there were 4 individuals due a refund. Then we also had 1 deferred vested participant. That's an individual who is entitled to a pension. They're vested, so they do have entitlement to a pension. If they don't withdraw their own contributions, but before they are eligible to retire, then they will end up getting a monthly pension benefit based on whatever they had earned to the point when they left employment with the city.
Okay, Mr.
Can you hear
Harrison?
me?
Yes.
Hey, this is Ken Harrison. I think also the people that were terminated and weren't vested have up to 5 years to leave their money in the plan on the possibility they could be rehired. At the end of that 5-year period, then we have to distribute the contributions that are remaining.
Thank you. Any other questions on the,
That was it.
Don, thank you.
Thank you.
Thank you, sir.
We need to make a motion to accept.
I say typically, we accept the audit as presented. Someone would
I'd like to make a motion to accept the audit as it was presented.
I'll second it.
Okay, any further discussion? All in favor?
Aye.
Any opposed? Okay, thank you, sir.
Thank you.
All right, next item on the agenda is accept the actuarial evaluation report for 10/1/21.
Can I sidebar for 1 second and just ask? So they're just charging us for assets under management, not head count, correct?
Correct.
So it's irrelevant that those,
Correct.
that's all.
Yeah, as far as I know, those employees that have left, that still have money in the plan, they have been contacted. I don't know if the league or the FMPTF proactively contacts them every year. If we can clarify that, but upon termination, they were given the paperwork and the procedures to withdraw their money.
Okay.
The 5 years is an ERISA rule. Regulatory.
Okay.
sorry. Thank
That's
you.
okay. So next item is the actuarial valuation report.
Okay.
All right. Hi, everyone. This is Chuck Carr. I'm the actuary for the plan. So today I'm going to just quickly review the October 1, 21 actuarial valuation. At a previous meeting, I've worked with so many clients, I don't remember when it was with you guys, but at some point in the last few months, we reviewed the alternative valuation results using several different interest rate assumptions. And so pursuant to that, the board made a decision at that meeting to reduce the assumed rate of return from 7% to 6.75%. And just as a reminder, FRS, I believe, has moved down to 6.8. So we're pretty much in line with where FRS is. Not that we need to be, but just it's interesting to note that we're kind of in the same place where they are. That was the only assumption change that is reflected here. So I'll just go right to the bottom line because we sort of went over the results before when we were looking at the different alternative interest rates. But the total required contribution rate for the current plan year is 27.06%. I say total because that includes the state money, the Chapter 175 money. If you look at page, and let's see, go one more page in the report. There we go, to the pie graphs. You'll see the lower pie graph shows you for last plan year what the percentage of pay worked out to be for the city as well as the chapter money. So last year, the city's contribution alone was 27.85% of payroll. And then the chapter money worked out to be 10.55% of payroll. And of course, employees contribute 5%. For the current year, these percentages are only estimates. They're estimates for two reasons. Number one, we don't know exactly what our covered payroll will be for the current year. And then two, we don't know what the chapter money will be because I assume it hasn't come in yet. And I certainly, I've not seen it. So based on the actuarial assumptions we make and based on, the numbers we estimate for this valuation, we're estimating that the city's contribution will be just over 16% of payroll. So we're estimating an almost 12% of pay reduction in the city's required contribution to the plan from last year to the current year. We're estimating that the chapter money, this assumes that, by the way, that it comes in at the same level that it came in last year. We're estimating that will equate to just over 11% of payroll. And when you put those two together, that gives you your 27.06% of payroll required contribution for the current year. And as I said a minute ago, the employees contribute 5%. If we go over, actually, you don't really need to turn there. It's on table 1-E as in Edward. The present value of accrued benefits. I just want to point out one thing at the bottom of that page. We show the funded percentage in the lower right-hand corner. That funded percentage is just over 134% funded. If you look in the middle columns, you'll see the under the old 7% interest rate, we were just shy of 140% funded. So we reduced our funded percentage by about 5.75% due to the 0.25% reduction in the interest assumption. 134% is very good. Sometimes when a client sees that the plan is over 100% funded, that leads to the question, well, why do we have a required contribution at all if we're over 100% funded? That's a very good and a very logical question to ask. The reason is this funded percentage is based on liability for benefits that were earned up to 10/1/21. So it does not reflect any liability for future benefits we expect to be earned by the current group. We do have a frozen active group, but we still have, I believe it's 9 people who are actively employed and they're actively accruing benefits under the plan. So when we add in the projected liability that we're going to have for benefits they're expected to earn between now and when they retire, we're not 100% funded on that basis. That number, in fact, is about $9.43 million of liability, 9.43, compared to actuarial assets at about 8.46. So we're a little under $1 million shy of our ultimate funding goal. And that's why even though we're over 100% funded on an accrued benefit basis, that's why we still have a required contribution. And of course, the contribution is what that tells us is that all of the contribution that we receive is funding active employee benefits, active employee benefit accruals. It's not being used to fund past service costs because we've already got those taken care of. So anyway, that's a good position to be in. The plan is obviously it's healthy. Now, I don't get involved in the investments, and I know I just was at another pension board meeting this morning. So I do hear from various clients from time to time about how the investments are doing for those different plans. So I know the world at large has not been kind to pension funds this year. And so who knows between now and September 30th where we'll end up. Wouldn't surprise me if we end up with a shortfall and we make something less than our 6 3/4%. I would say at this point that's probably likely, but we'll have to see. But we have, the plan is well funded. We can certainly afford to, we can withstand a year or even a couple years of bad investment returns. That's, it might rock the boat a little bit, but it's certainly not going to put the plan at risk or anything of that nature. As I said before, the city's contribution requirement is expected to drop by close to 12% of payroll from last year to this year. So, we may end up increasing that back a little bit for next year, depending on how assets perform this year. But hopefully none of that will adversely impact the city's budget, and it certainly shouldn't adversely impact the plan. We're in good shape. That's pretty much the valuation report in a nutshell. Does anybody have any questions on the report or anything of an actuarial nature that I could address?
Anybody have any questions?
No.
I got to throw the one crazy off the wall one, and I apologize again. The Fed keeps raising rates, and we start getting to where you can get CD rates for 7%, 8%. If we're doing that and we say switch everything to a CD for several years at 7 or 8%, would that impact anything if we're just staying dead on line with the our 6 3/4 number?
Yeah, I would say if you were able to get a guaranteed 7 or 8% investment return, guaranteed, that's important, then we probably could look at taking the 6 3/4% and we might bump it back up to 7 or so. The problem is two comments on that. First of all, even if you get a CD today at 7 or 8%, even if you could do that, there's going to be a time limit. In other words, you're not going to be able to buy, or at least I seriously doubt you're going to be able to buy some type of fixed income investment that will guarantee you that level of return for the next 30 or 40 years. So we would be talking about, maybe 5 or 10 years when you might be able to have that higher return locked in. So, we'd still want to look at overall for the long term, what do we think the trust would earn? Because it may well be if you locked in that interest rate, even for 10 years, what's going to happen after that? You may be back, CD rates may be back at 0.5% or something at that point. We don't know. The other comment I'll share with you, and let me preface this by saying I am absolutely not an investment consultant, and so do not take what I'm about to say as investment advice in any way, shape, or form. I'll just share with you what I actually heard at the meeting I was at this morning. I was at the City of Atlanta Pension Board meeting, so they are not surprisingly my largest client, but their investment consultant was. Of course, nobody knows, but he suggested that he felt it was more likely than not that interest rates will actually in 2023 come back down, that the Fed maybe was overreacting a little bit to the current inflation situation. I don't know if that's a perspective that's shared, widely out there in the investment world, but from what I heard today, and I've heard this at some other meetings as well, I don't know that we're going to see things like CD rates. I don't think we're going to have a repeat of the late 70s and early 80s when you could get these huge interest rates on CDs. I certainly wouldn't hold my breath for that. It could happen. Anything's possible. But based on what I was hearing, I'm not sure that's a likely thing to happen. But regardless of that, it would take a lot for us to want to move that 6.75% interest assumption back up, certainly to something above 7%. I think we really have to have a fundamental shift in our long-term expectation with respect to the investment return. And again, I don't know how likely it is that you'd be able to lock in, a 7 or 8% return for the long haul. And that's of course what we look at. We're not too concerned about, the next 5 or 10 years. That's the very short term from an actuarial standpoint. So I don't know if I answered your question, but those are kind of my comments on that.
May I speak?
Yes, thank you.
Hey, Ken Harrison, just a couple comments on what Chuck has input. That question is better asked of your consultant. And as Chuck indicated, most of the consultants that I've been aware of in the last, 6 to 8 months are suggesting a reduction in the expected rate of return. So it's not likely that you're going to see that happening anytime soon. In addition to what Chuck explained about why you need to have a employer contribution, we also have a state law that says the employer must contribute to the plan each year, whatever the normal cost is. And the normal cost is those new credits that go to existing employees every year. Every year there's a little bit more added to that liability for existing employees, and that by statute must be contributed. So, and that came about because of what happened in the 90s when we had another market that was doing well. And in fact, a lot of the employers said, well, we don't need to make any contributions at this time because we're overfunded. And of course, 2001 came along and that changed everything real quickly. And they had to make some significant contributions. So the state opted to introduce this new requirement that any annual cost or new cost would have to be paid for every year. You cannot ever bypass making a contribution regardless of what your investment return is. So just to clarify those 2 points.
Yeah, I think what I was really targeting is if you can lock in a 5-year at 7%, do you guys then at that time say, okay, we get the 5-year at 7% in a CD, and then can we say we're going to convert back to the market at that point? Or does that impact your 30-year actuarial table that you're running?
Well, like I said, I don't think even if you could lock in, say, 5 years, a 5-year return at 7%, I don't think that would be enough. It wouldn't be nearly long enough, at least from my perspective, for us to consider changing the 6.75% assumption.
Yeah, I'm not worried about that. I'm just saying it would still lock in the returns for the time frame, but that's fine.
So I see what you're saying. You're saying, in other words, if you could find a way to essentially de-risk the portfolio, at least for the next 5 years, would it make sense to go basically to cash, like to CDs, knowing that you can earn your return the next 5 years and you're not sitting at the table anymore, so to speak. You left the poker game temporarily. And then at the end of the 5 years, then you go back to the market. I suspect, and again, this is not an investment advice, but I've had similar questions come up. I've heard similar questions be asked over the years. And usually what the investment consultants will tell you is that is just a different way of market timing. In other words, if you said, we think the next 5 years in the market is not, stock market is not going to be that good, let's go to all cash. We can basically know we can earn our 7% and we'll be good. You still may not be advised. It still may not be advisable to do that because you're taking a gamble that at the end of the 5-year period, that when you get back into the game, that it'll be a quote unquote normal market or whatever with a normal expectation. What could happen in the 5 years is you could have the next 2 years could be really bad with investments, and then you could have another 15 or 20% year that you miss out on completely. So I suspect the consultants will say that is kind of a different way of doing a market timing. You essentially go to cash, lock in a return for a period of time, and then get back into the market. That's usually considered kind of a market timing approach, which most of the advisors that I've heard, advise against that. But I mean, I suspect, I mean, I'm sure there's, Ken can opine on the legal perspective of, whether that's something that would be advisable from a fiduciary standpoint, a money management standpoint, to go to cash and then get back in the market. But I suspect that's what the investment advisors at least would tell you.
You're good. I hope it never presents itself. How's that?
Okay.
Thank you. Any other questions? Thank you, Chuck. Appreciate it.
Okay. If there are no other questions, there is one other order of business for my part, and that is you're not obligated to do this at today's meeting by any means, but technically, until the pension board formally accepts the actuarial valuation, it is just a draft. It's only at the point that the board accepts the report that the 27.06% contribution rate becomes the legally required funding requirement for the city. So if you're inclined to do that today, if you're happy with the report, then I think a motion would be in order to accept the actual valuation. If the board does accept it at today's meeting, we have 60 days to get the report filed with the state, which we do electronically, excuse me. Usually within a few days of your accepting the report, Lisa back in my office will get that filed with the state, and then that would conclude the sort of normal actuarial business for the current year.
Correct. Yeah, that'll be our next action. If there's no further questions, need a motion to approve the actuarial report as presented.
Move to accept as presented.
I second.
Any other further discussion? All in favor?
Aye.
Any opposed? Okay, approved. Thank you.
I believe you asked.
All right. Well, thank you guys. I'm going to exit the meeting, but if you need me for some reason, I'm just sitting here working. So if you need me for some reason, just shoot me an email and I can jump back in if I need to.
Okay. Thank you. Appreciate it.
All right. Thank you. Good to see you all virtually. Take care, everybody. Bye-bye.
Thank you. Hey, I believe we also have to accept the expected long-term interest rate assumption of 6.75%. That will require a different motion. Ken, Mr. Harrison, if you can chime in on that.
I thought we had approved that at our last meeting, that the
I
change.
thought we did that. That was with Pedro, right?
Yeah, that wasn't
Yeah.
really approving it. It was
Okay,
directing the actuary to prepare the report
with that.
with that.
Okay. So do we need to amend our,
You would need a separate motion to approve that letter to the state.
okay. So we need a motion to accept the expected long-term interest rate assumption at 6.75%.
I'll make the motion to accept it at 6.75%.
Second.
Okay, any discussion? All in favor? Aye. Any opposed? Okay, so approved. Thank you. Next item is approving the invoice for the audit standalone financial statements.
Okay, we have an invoice presented for $6,650 for Wells, Hauser, Schatzel. This is for the audit work and the presentation, the preparation of the standalone financial reports and the presentation. This is an agreement with the engagement letter the board had previously approved. Just for perspective, the full report was the $6,650. The other option for the non-standalone report, which would have been incorporated into the city's financial reports, would have been $4,600. So that's the difference between the two. But again, the invoice is in agreement with the engagement letter. And we don't see any problem with it.
Move to approve the audit standalone financial statement invoice.
I second.
Any discussion? All in favor?
Aye.
Aye.
Aye. Any opposed? Thank you. Approved. Okay, next item is the invoice for the FMPTF actuarial valuation report and letter to the state.
Okay, this is the invoice for the Southern Actuarial Services, Chuck Carr's preparation of the valuation report. Again, this is, the board had accepted a not to exceed amount because at that point, when we approved the FMPDF to prepare the valuation report, we didn't have the cost estimate yet. But this does fall within the not to exceed direction of the board, and it's appropriate, it's certainly a reasonable price for the report that he prepared.
Okay. You have a motion to approve the invoice?
Move to approve the invoice.
I second.
Any discussion? All in favor?
Aye.
Aye. Any opposed? Invoice approved. Next item is the the FMPTF invoice for the alternate valuation results based
Okay.
on the interest rate assumptions.
Okay, the board had asked the actuary to prepare a report to calculate the contribution rate with various interest rate assumptions, with the 6.75 being one of them, 7% is the other, and then there was a third request as well, 6.5. The board also agreed to a not to exceed price of $1,000. We questioned Chuck Carr about this. He agreed it should have been $1,000, so we will request a corrected invoice from the FMPTF, and Chuck has directed us to only pay $1,000. So the board's motion would be to approve payment for the actuarial services, or the additional actuarial services at an amount of $1,000.
Okay.
It's Kenny's turn.
What was the motion again? Sorry.
Need a motion to approve the invoice for the alternate valuation results.
At a corrected amount.
And
All right, I'd like to make a motion to approve the invoice to the corrective amount.
Second.
of $1,000.
Yeah.
Sorry.
Second. Any questions, discussion? All in favor?
Aye.
Aye.
Any opposed? Okay, approved for the $1,000 for corrected. Okay. Next item is approving the invoice for the FPPTA member dues renewal for 2022.
Okay, we have maintained this membership for a number of years, and it provides us access, the board members, to various training opportunities and information that the FPPTA puts out regarding the pension plans. This is within the administrative budget. It has gone up a little bit, as everything else has, but I believe $750 is a reasonable amount for this invoice and this membership.
I'd like to make a motion to approve the FPPTA membership for 2022, $750.
I'll second it.
Any questions, discussion? All in favor?
Aye.
Aye.
We're just spending money like crazy.
Right? I don't like this one. So anti-me.
And the next one is ratifying the FMIT invoice for the fiduciary liability insurance renewal.
Okay, this is the last invoice on this agenda. This invoice was due July 1st. We had initially planned to present this at the June 1st meeting. It was canceled and we're postponed until today. This is the second year of a 3-year policy. The board had previously gone out for quotes last year, and the FMIT had submitted a favorable quote for the $1,893. It's the same insurance company, same coverage that we had previously, so we went ahead and accepted it. Again, this is the second year of the 3-year policy. We went ahead and paid the invoice and then submitted it for ratification. We did not want any lapse in the coverage, so we believe this invoice is appropriate, and it is in agreement with the policy that was secured last year.
Move to approve the payment of the invoice for the fiduciary liability insurance.
I second.
Any questions, discussion? All in favor?
Aye.
Any opposed? Thank you. And next item on the agenda is an attorney update.
And we have
Okay.
the audit engagement.
Oh, did I skip that? Oh, I did, I'm sorry. Consider the audit engagement letters for the fiscal year 9/30/22. The integrated or separate financial report.
Okay, we're getting close to the end of the fiscal year again, so we wanted to go ahead and present the audit engagement letter options for the board to consider. The first option you will see in the packet is for no standalone report, and that means the audited financials will be incorporated into the city's annual comprehensive financial report. The second option would be to have another standalone report. Historically, the board has elected to have a standalone report every other year, but again, that's the decision for the board to make. The non-standalone report is $4,700, and the standalone report would be $6,800.
So we have typically, like somebody said, altered them back and forth.
So the non-standalone is the one that costs less?
Yes.
Yes,
Because it's included in the city's report.
right, and you just did the standalone, so I'll make a motion to approve the non-standalone report.
Second.
Any discussion or question?
Yeah, the auditor will still present the financials, but he will go through the city's audited financials and kind of go through the pages that are relevant to the firefighters division.
Okay. All in favor?
Aye.
Aye. Any opposed? Okay.
I had in my notes here, standalone versus non-standalone. I was questioning what that was, so you answered that. Thank you.
Okay. Now the attorney update. Mr. Harrison, we appreciate you being here today.
Oh, glad to be here. Unless you have questions of me, I really don't have anything to update. The legislature right now seems to be more focused on the upcoming midterm elections. And if you've been watching the ads, you can see some of the political activists have been active presenting ads. So that's about most that's going on in the legislature. So unless you have specific questions of me, that would conclude my report.
Okay, thank you. I do have one question. I had a member ask me how they would go about purchasing military time.
Okay. They
have-
basically would have to apply and apply to purchase the time, telling us the specific time periods. And also they'd have to provide documentation that when the service occurred. That's assuming that this is service prior to employment. If it's service that occurred while they were employed, that's an automatic provision covered in the statute. They would be treated as if they never left when they returned. So depending on the specifics of that request, the answer may vary.
And so it was service prior to employment? How would
Yes,
they know?
they
I'm
can
sorry.
purchase service prior to employment. They have to make application
Okay,
through your administrator, and they'd have to provide documentation of when the service occurred. For instance, military orders, DD 214 form, those are the kind of things that they'd have to provide, and it would come before the board to approve. And of course, it would have to go to the actuary to figure out the cost. And they would be required to make whatever contribution the actuary calculates.
okay. Thank you. Any other questions?
Did we ever bring up about the step plan and all that stuff, or
So there was a question,
not step plan?
the drop.
Yeah, the drop.
The power of this board does not have, we're not able to determine benefits, is that correct? We're only overseeing if the financial,
Yes, your job is to administer the plan as enacted. For any benefit change or anything like that, it goes through the collective bargaining process. If the parties then agree, we would have to adjust the document, the plan document, to reflect those changes. But your primary job is to administer what's been enacted by the municipality.
okay, thank you. Does that answer your question?
Yeah.
Okay. No other questions? Thank you, Mr. Harrison.
You're welcome.
Are you guys done with negotiations for the year?
No, they're still in the process.
Hence the drop question.
What is drop?
Deferred retirement option, I forget what it's,
Yeah, I can't remember. It's a 5-year,
Deferred Retirement Option Program.
thank you.
and it's not a cost to us to change it. Because I guess it's included in our plan. That's what we found out last time.
The theory of a drop is it should be cost neutral. However, a lot of the drops have a provision in it, and IRS takes a hard look at drops, that if you potentially can lose principal, they have an issue with, IRS has an issue with it. So if the plan that would be negotiated actually provided that you could not lose principal. In other words, if the plan loses money, you would not. You could not lose your principal. There then evolves a minimal cost if that's the plan that's adopted. So, but the original plan of a drop is be cost neutral. Whatever the plan does, the drop account would reflect that, and there would be no cost to the plan. But again, it depends on the type and the formal language that gets adopted in the collective bargaining agreement.
As part of that, are you guys aged locked in with the state in the same fashion they would be of 59 or 61 or whatever
Ours
it
is, what is it, 55 and 25?
Yeah.
The state right now, it's 60/30. Supposedly they're talking that it might be changed, but right now the state is 60/30.
But yours is collective bargaining locked in at the 55-25.
Yep.
Yeah.
Any other questions? Okay. Next item is to adjourn.
I make a motion to adjourn.
I second.
All in favor?
Aye.
Thank you.
Thank you.
Thank you.
Are we required to keep these or recycle them, or, I mean,
It's up to you.
okay.
They're all available on the website as well.
Right, yeah.
I think they provide all those.
Did you guys participate in the Pinellas County Schools?
No. That was more like South County, mid-South County.
Oh, the drill?
Yeah. You guys have had some crazy calls in the last 3 or 4 weeks. Because I've driven by a couple of them.